Hi, I'm Linda Eedes. This is an update on the RECM Balanced Fund, which is of course our Regulation 28 Balanced Fund, looking specifically at the third quarter of this year, looking at the returns, some of the contributors and detractors to those returns, some of the changes to the fund over the quarter, and of course how the fund is currently positioned. So if we look at the quarter, the fund was down slightly during the quarter. The return after fees was negative 0.4%. So fairly flat for the quarter, but actually not too bad if you consider that the all-share index was actually down 4.6%. So I think we often think that what happens locally has got a lot to do with local politics and our local issues, but in actual fact during the third quarter it was an emerging market story. In fact, the emerging market index as a whole was down 4% in US dollar terms. So it wasn't just the South African market that came under pressure. US markets continued to rally, and a lot of developed markets were actually up slightly, and of course the rand also depreciated slightly. So having some offshore exposure was a boost to the fund overall and helped to protect, as well as us not having a lot of the stocks which came under pressure during the quarter. Our local equity portion is positioned very differently to the all-share index, and that is a huge advantage when the market does come under pressure. It's part of why the fund has performed so exceptionally well since the beginning of 2016. Since the start of 2016, the fund is actually up 33% after fees in comparison to the average of its sector, the CISA sector in which it falls, which was 15% over that time frame. And if you just compare that to the JSE All-Share Index, remembering of course that we can never have more than 75% of this fund in equities, so it's not really a very fair comparison, the All-Share Index was actually only up just under 20%. So the Balanced Fund being up 33% in comparison to that, where we actually constrained in terms of how much equity exposure we can have, does speak to some of the advantages of our style, which is that it does protect very well when markets come under pressure, and the fact that we are a smaller manager means that we can access a far wider opportunity set on the local side. So where perhaps larger managers are more tied to what happens to the Aussie 40 stocks, we are able to have quite a varied exposure, which may be quite different to that, and which will, in many instances, as you saw this quarter, generate quite a different outcome. Talking specifically to the stocks which contributed versus detracted over the quarter, the gold stocks that we have in the portfolio, we have a small gold basket, which is really a bit of insurance. Gold prices were up during the quarter on the back of these low interest rates. That did benefit some of the gold stocks we have in the portfolio, such as Anglo Gold Ashanti, Harmony Gold, and Barrick Gold on the global side. So that contributed to returns. Implats continued its rally, up more than 27% during the quarter. The platinum producers have benefited from a huge increase in the PGM, the whole basket of platinum group metals, in particular rhodium and palladium, not so much platinum, which has actually not done as well, but certainly that's been a boost to the platinum producers and helped the returns of the fund. And another stock which we actually introduced on the global side last quarter is Brookfield Asset Management. That is an infrastructure investor, invests in infrastructure assets as well as renewable energy, and that share price typically does tend to do quite well when there's an expectation of low or declining interest rates, given how far the cash flows for that business are into the future, and discounting them to present at a lower interest rates means a higher present value that you're prepared to pay. In terms of detractors, some of the local stocks did come under a bit more pressure. Stocks which we still have a high degree of confidence in as value opportunities, such as HCI, Hoskin Consolidated Investments. Now that is an investment holding vehicle which has exposure to gaming and leisure by virtue of its stake in Tsogosan. Now this share price is so low for the investment holding vehicle that if you actually just exclude all of its other interests, it has media interests, transport interests, mining interests, if you just look at the Tsogosan exposure that it has, if you actually just look at the listed share price of Tsogosan, which itself has been under immense pressure and which arguably itself is hugely undervalued, the HCI share price is actually trading at a discount to that alone. So that gives you an idea of how undervalued that specific investment is, but certainly did come under a little bit more pressure during the third quarter. We do believe that downside is limited with substantial upside on the back of a very good capital allocator and an impressive track record for that business historically. The domestic banks came under a little bit of pressure as well as some of the emerging market exposure on the global side, similarly, private banks such as Brazil. So again, it's not just a local story. Many emerging markets are actually under a little bit of pressure. In terms of changes to the portfolio structure during the quarter, we actually increased our exposure to South African bonds. Now remember that bonds compete with cash within that 25% allocation in the Reg 28 constraints, with yields about 9.5%. I mean, that represents quite a substantial real return of about 5%. And we believe that was worth allocating to. So we actually took the bond allocation from 5% to 10% during the quarter. The global portion through market movement is now above the 30% threshold. It's at 32%. We were very comfortable with our global allocation. We have about 11% of that is actually exposure to the UK, a combination of some of the UK stocks, which are undervalued as a result of Brexit uncertainty, and allocation to sterling as a currency. So we believe that the sterling in itself is actually undervalued and represents an attractive investment idea in itself, along with the yen as well for similar reasons. So the fund currently has quite a broad mix of small and mid caps as well as some large caps which are undervalued on the local side. We're very comfortable that on the global side we have exposure to high quality businesses which are trading at a substantial discount to what we believe to be their fair value. We've got some interesting allocations there, lots of different investments which are going to be driven in terms of the unlock in value by many varied things. So we're not predicating the success of this portfolio on some macroeconomic theme and hoping that we're going to be correct about that. We're basically trying to build a portfolio which is incredibly robust, which is able to withstand market downside, which it has done very successfully, and which, as time goes on, each of those individual value opportunities will unlock and ultimately generate an attractive absolute return profile for investors in the fund.